magnificent, 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 magnificent.
In the last episode, we covered price discovery. Now it's time to understand what happens after that price prints. Execution is fast, settlement isn't. When there's a trade, the market has agreed on a price and moved on, but the trade itself is still unfinished. What exists immediately after execution are two obligations that have to be completed later. The buyer owes cash, the seller owes shares. Settlement delay exists because continuous trading requires it. If every trade had to deliver cash and shares instantly, markets would grind down. Participants would need pre-funded cash for every purchase and pre-positioned shares for every sale. Delayed settlement gives the system time to confirm trades, net obligations, source inventory, move cash, and reconcile positions in bulk rather than in real time. That delay is a trade-off. The market gets speed and scale, and in exchange, it carries unsettled risk for a defined window. In US equities, that window is T+1, trade date plus 1 business day. That's when cash and shares are expected to exchange hands and positions become final. Shortening settlement reduces how much unsettled risk the system carries at any moment, but it doesn't remove the need to manage the possibility that a participant can't perform between execution and settlement. That management happens through clearing. Without central clearing, the market is a web of private credit exposure. But with central clearing, risk becomes centralized, standardized, and governed by rules. The system can net obligations, collect margin, monitor exposures, and handle failures through defined processes rather than ad hoc credit decisions. Once trades are cleared, the system nets. If you buy 10,000 shares during the day and sell 9,800 shares during the day, the system doesn't want 19,800 shares of gross deliveries moving back and forth. It wants the 200 share difference that actually needs to be delivered at settlement. But netting has a condition. It works best when flow offsets. When activity becomes one-sided, netting stops being a compression tool and starts being a magnifier. Offsets disappear, net obligations grow. The system is forced to carry larger directional exposures into settlement rather than canceling them out. The system prices that replacement cost with margin. It's a forward-looking estimate of what it would cost to replace unsettled obligations in the market if a participant fails. That estimate changes with market conditions. Volatility matters because it determines how far prices can move while an obligation remains open. Concentration matters because one-sided positions are harder to replace without moving the market. Correlation matters because offsets and hedges are assumed to behave consistently. And time matters because exposure duration increases uncertainty. When volatility increases or correlations break, margin demands rise. That's why stress often appears after the price move, not before it. Then the clearing system recalculates the costs of guaranteeing the price under new conditions and demands collateral accordingly. Price discovery is an agreement. Margin is enforcement. Settlement is where enforcement becomes final. On T+1, cash and shares are due. If they exchange successfully, the obligation is extinguished. If they don't, the obligation persists as unsettled exposure. That persistence is what a failure to deliver represents. An FTD is an incomplete settlement obligation. The seller didn't deliver shares by the deadline, or the system couldn't complete delivery as expected. Time is what turns unsettled obligations into pressure. That's why escalation frameworks are based on calendar time rather than trade count. Risk exists continuously. Exposure doesn't pause on weekends. And the longer an obligation persists, the more likely it is to collide with other constraints like funding cycles, reporting periods, and margin recalculations. This is the core intuition behind threshold frameworks. When settlement failures persist long enough and remain large enough relative to activity, the system treats them as a structural issue rather than a timing issue, and mandatory closeout requirements can apply. Options make this dynamic more visible because they produce obligations that mature on a schedule. Options exposure is centrally cleared and continuously margined. Even when no one is exercising, the system is still measuring replacement costs and demanding collateral. As price and volatility move, margin can change meaningfully without corresponding cash market volume. Expiration concentrates that effect. When options expire, optionality disappears and offsets often disappear with it. That's why dates like OPEX and quad witching are significant. They're periods when large sets of obligations mature simultaneously. The system has backstops designed to prevent settlement stress from instantly becoming collapse. Central clearing, default resources, and liquidity facilities exist to buy time and smooth resolution. The sequence is clean. A trade prints and creates obligations immediately. Clearing converts those obligations into standardized exposure. Netting compresses exposure when offsets exist. Margin reprices exposure as conditions change. Settlement enforces completion on a deadline. Failures extend exposure forward. Time forces resolution as constraints tighten. Price discovery tells you where the market agreed. Clearing and settlement tell you whether the system can make that agreement real under pressure. A trade isn't finished when it prints. It's finished when it settles. Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.